Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Well, I'd like to welcome to the show David McKnight. David, welcome to Renovating Retirement. How are you doing today?
Good. How are you doing, Charlie?
I'm doing wonderful. I've been a fan of you and your work, and I've wanted to interview you for a long time, so I'm really glad we're doing this.
Well, thanks for having me.
So the book I'm most familiar with, I know you have a new book out, but the book I'm most familiar with is How to Be in a 0% Tax Bracket. I guess you call it The Power of 0%, right?
Power of Zero, that's right.
So I want to get into that in a minute, but why don't you just tell me your background and kind of how'd you get into this crazy line of work, same line of work I'm in, but how'd you get here?
So right out of college, actually, I've never known anything other than the financial services industry. Right out of college, I went to work for MetLife Financial Services out of Salt Lake City, Utah, and fell in love with the industry and been doing this, really helping people sort of organize their finances and ultimately get to the 0% tax bracket by accumulating the right amounts of dollars in the right types of accounts. I've been doing that for about 20 years, so it's been a great ride.
You're a lifer, huh?
Yep, I've been here since the beginning. That's right.
So we have a similarity in that we did not start on the stockbroker side, but started on the insurance side. And I've found incredible advantages in that over the year, just because the tax planning piece of this, it does not seem that the stockbrokers, which if you listen to the show, I call them the joker brokers, right?
Mm-hmm.
It doesn't seem like the stockbrokers really even address that aspect at all. But that's a big part of financial planning.
All right, it's a huge part, and historically, you have the insurance guys, and you have the accountants, and you have the joker brokers, and they all did their separate thing, and none of them really communicated with each other. And really, that has to be an integrated effort, and if it's not an integrated effort, then something's going to be left out in the cold.
So having said that, I wasn't going to talk about this, but hey, why not? We're going spontaneous, right?
Right.
Having said that,
Right.
you may understand when I got into the industry as a rookie and I had some real estate and mortgage experience, I was sitting there going, this is not very comprehensive. This is not like when I was an electrician and we had blueprints and financial architecture and everybody worked together. It was very narrow, right? Kind of like what you just said. And I was having trouble naming the company. And finally, one day, the thought popped into my head, stop thinking about the name. What do you care about? And in this order, actually back then it came out: mortgage planning, estate planning, real estate strategies, investment strategies, tax strategies. And now that has since morphed into mortgage planning, estate planning, retirement planning, insurance planning, and tax planning. But we're saying the same thing. Really, this is a comprehensive effort where everybody needs to work together, and anything that affects your finances really is part of financial planning, right?
No question, absolutely.
Well, I love the book. Now, there's most people are planners for a while, or most authors don't write a book as the very first thing they do. I imagine you had some years working, but where'd the book come from? Why did you want to write a book?
Well, I've been trying to raise awareness on the likelihood that tax rates in the future will be dramatically higher than they are today. I've been trying to raise awareness on that for 15 years. And I began giving a presentation. It started off as a 5-minute presentation. It involved 3 different buckets, 3 different types of money. There's taxable, tax deferred, and tax free. And the idea was that most people I ran into had the lion's share of their wealth in the taxable and tax deferred buckets, hardly any money in tax free. So I sort of evolved this presentation over a 10 to 15 year period, and I honed it and refined it. And every time I gave it, something came out of my mouth differently, and it worked, and I kept it. If it didn't come out quite right, I sort of discarded it. And after about 10 to 15 years of this evolution and refining and polishing, I had a presentation that they asked me to do at the worldwide annual meeting, $1 million roundtable. And that was the presentation that I basically decided to commit to book format. So what you have right now is The Power of Zero. The Power of Zero is the book version of that presentation that I refined over all those many years. And I think it's the sort of the field tested concepts in that presentation that made the book so popular.
Well, let me give you a bit of feedback and praise from my customers that you probably would never know if I didn't mention it. But there's a lot of books I've handed out over years because there's some great authors talking about how to have a tax-free retirement and things like that. Your book, honestly, is the only book for the most part where people will come back after reading it and say, "I want to do that. Tell me how to do that," which is just awesome.
Yeah, we had a guy a financial advisor who was sending the book out to a lot of his clients. He was at the post office. He had 50 books piled up. And the guy next to him in line said, what are you doing? What's this book? He sort of told him, about the book. And the guy said, well, can I have a copy? And he gave him the copy. And the guy called him back 2 weeks later. He said, can you help me experience the power of zero? And the guy ended up becoming a great client. So it definitely evokes a lot of feedback and reaction from clientele.
It's really, really cool. So you're familiar with David Walker, right?
Yeah, absolutely.
So do you agree? I mean, you say you've been trying to raise awareness that taxes will probably go up for 15 years. Most people can't see, but there's that chart of the marginal tax rates and where they've been, and they're pretty darn low, honestly. Do you agree with David Walker that we either, as a country, we either have to cut benefits in half or double taxes in the future?
Yeah, or some combination of the two. I think it will probably end up being some combination of the two. It's interesting when people really sort of contest me on this little fact that I say in my book that tax rates are likely to rise dramatically, if not double over time. They really sort of call me out on it. And I say, hey, look, no less an authority than the Comptroller General of the federal government, David Walker. He's in the CPA Hall of Fame. He knows the fiscal condition of our country perhaps better than anyone else on the planet. Has said that we are on the pathway to ruin. We're basically got this fiscal cancer that's eating us from within. Unless we double taxes over time, we're going to sort of sink into insolvency. So I don't profess to be any smarter than David Walker, but I've studied his life, I've studied his work, I've studied his writings, and he's pretty clear. And he gets confirmation from a number of other experts who've also studied the numbers. He says, look, if you're good at history and you're good at math, you have to agree that tax rates eventually will go up.
And he does that, doesn't he? Say that I'll give you one four-letter word to prove it, and it turns out to be math. Is that
Yeah,
he's the one that says that,
yeah,
right?
math is the four-letter word that explains why tax rates have to double.
To me, even the fact that the biggest generation, the baby boomers, stuffed all this money in yet to be taxed yet to be taxed accounts like IRAs and 401ks, just that alone, doesn't the temptation to the IRS to sneak taxes up a little bit to get as big a piece of that, just that alone makes me think taxes might go up.
Well, that's what they've done historically. People, I gave a workshop last night, and the lady said, well, what if I do a Roth IRA and they decide to tax my Roth IRA? And I said, why would they do that? Historically, what they've done when they need a greater influx of cash is they simply raise tax rates. You are, when you have a tax deferred account, you are in a business partnership with the IRS, and every year they get to decide what percentage of your profits they get to keep. So why would they do it any differently? Why would they sort of raise all these red flags by taxing what was previously a tax-free vehicle when they can simply raise their percentage of ownership on your account?
Exactly right. Now, you in the book have a story about Ronald Reagan that's just super poignant and kind of proves this whole point. Do you mind running through the Ronald Reagan story?
Sure. So Ronald Reagan, back in the day, and I sort of opened my workshops. I asked the question, what's the highest marginal tax bracket in the history of our country? And people say 50, 60%. Actually, back in World War II, the last 2 years of World War II, the highest marginal tax bracket was 94%. And that was for any dollar that you made above and beyond $200,000. Now, there weren't a lot of people back then that made that type of money, but Ronald Reagan was one of them. He made about $100,000 per movie, and he never made more than 2 movies in a year. Reason being, any dollar he made above and beyond $200,000, he only kept 6 cents on the dollar. Truth be told, he didn't even get to keep the 6 cents. That 6 cents went to the state of California for state tax. So if you study Reagan's biography, he talks about how he never made more than the 2 movies. After June, he would take the rest of the year off and start making movies again January 1st the following year.
It's amazing. And he ends up going into politics, right?
Right.
Very, very cool. Thank you. Now, who can be in a 0% tax bracket? So when I read the book, I learned a ton of stuff. I'll mention a little bit about my favorite thing, but who can be in a 0% tax bracket, and who has a situation where it's just not possible, so we're just going to minimize taxes? I know pensions play a role in this, right?
Yeah. So if you have a pension that's greater than your standard deductions and personal exemptions, which if you retire today would be about $20,600, you're not going to be in the 0% tax bracket. It's just going to be impossible. If you have a pension that's lower than that, then your pension can be offset by those standard deductions and personal exemptions. So most people that have a decent sized pension will never be in the 0% tax bracket. So the question becomes, how can you get them as close to a 0% tax bracket as possible? But virtually anybody that doesn't have that perpetual stream of taxable income that's coming into their lives can be in the 0% tax bracket. The question is, at what price? If you have $10 million sitting in an IRA, it's going to take a lot of shifting and a lot of tax paying to get that money to tax-free and ultimately get you to the 0% tax bracket. So conceivably, it's possible. You just have to sort of ask yourself, do you truly, in your heart of hearts, believe that tax rates in the future are going to be higher than they are today? If so, it makes sense to get that money shifted over. But really, the only people that can't get to the 0% tax bracket are those that have pensions or rental income or some other stream of income that shows up on the IRS's radar that's greater than standard deductions and personal exemptions.
Yeah. And you mentioned that as the perfect timing because my next point here, I really just said that the biggest piece that you added to my life, just making me better as an advisor, honestly, was that piece. You don't have to convert all of the IRA money to Roth IRA. That'd be paying unnecessary taxes, and it's because of that standard deduction, right?
That's exactly right. People often make the mistake. They say, hey, look, I want to get all of my IRA shifted out of my tax deferred bucket because I don't want to pay the taxes. Well, guess what? You want to have that balance in that tax deferred bucket be low enough that when the IRS forces you to take required minimum distributions, that those required minimum distributions are low enough that they can be offset by that standard deduction and personal exemption. But you also want it to be low enough that it doesn't cause your Social Security to be taxed, because anything that comes out of that tax deferred bucket is what's called provisional income. And that provisional income is what goes into the formula that determines if your Social Security taxation, if your Social Security gets taxed. And that's a big deal because my numbers show me that if a person has their Social Security taxed, they've got to take money out of other accounts to compensate for it. And it forces them to spend down their other assets typically 5 to 7 years faster than people who do not have their Social Security tax. So there's all sorts of different sort of landmines that you got to watch out for in this whole process.
You may understand how this happens in the industry, but I was in the industry for I think 7 or 8 years before I even heard of the tax torpedo. Before I even heard
Mm-hmm.
that there is such a thing as decisions that we can make that determine whether or not your Social Security is taxed. So my guess is most people, just regular consumers or retirees, may have no idea what we're talking about. But you don't have to have up to 85% of your Social Security to be taxed if you're in certain situations. You can move things around and change that, right?
Yeah, so we should probably spend at least a minute or so talking about provisional income. And this is something that most people haven't even heard about. I mean, I was giving a conference to 100 CPAs a couple months ago, and I said, hey, raise your hands if you've heard of provisional income. And how many CPAs would you think raised their hand? It was 2 out of 100. 2% of the CPAs knew what provisional income was. So what is provisional income? Provisional income is the income that the IRS keeps track of to determine if your Social Security is going to be taxed. If as a single person you have provisional income that's greater than $34,000, or if as a married couple it's greater than $44,000, then up to 85% of your Social Security becomes taxable to you at your highest marginal tax bracket. For the average American, it's going to cost you between $5,000 and $7,000. So it's a big, big deal to have your Social Security taxed. So if you can reduce your sources of provisional income, which are basically 1099s out of your taxable bucket, any distributions at all out of your tax deferred bucket, and 1/2 of your Social Security. So if you can sort of manipulate that through asset shifting to get to the point where you're not breaching any of those thresholds, you can actually get to the point where your Social Security is tax free.
That's awesome. So I'm going to do a show on the Tax Torpedo coming up here. Doug Warren, who talks a lot about it, is about 45 minutes up the road here from me.
Mm-hmm.
And during kind of the tax week where this show is going to air, I'm going to do a show on that. But it's a huge piece. I mean, I got so excited when I first learned that. Like, this is serious, a seriously big piece of financial planning is deciding whether you want to pay taxes on Social Security or not.
Yeah, I mean, I make it a point to talk about it with every client that comes in, and I would say that probably 2% of the people that I talk to know about Social Security taxation, know what they can do to sort of avoid it, and how to position their assets so that they can get all of their Social Security. But it's a hot button with literally everyone we talk to.
So I tell the story, and people that have listened to all my podcasts would know this, but I tell the story of getting into this business, really learning the tax-free growth and sort of tax-free retirement side of life insurance, which your next book is about, which we'll talk about. But I went out and looked for a CPA that understood what I was talking about and could work together with me and interviewed, I don't know, 20, 30. It was a really unpleasant experience, but long story short, I didn't find anybody. Then I went to a local estate planner that actually knows. He actually went on his Mormon mission with another really famous author, and I thought, well, surely he knows this, right? And I said, you've got 50,000 clients in California for estate planning. What CPA can I work with that'll understand this kind of comprehensive and sort of tax not just do your taxes every year, but minimize the taxes over your entire lifetime and after you die, right? And he said, Charlie, I don't even have one. And I thought, this is crazy. What do you think this is? I mean, I know my version of this is, hey, there's 40 times more words in the tax code than there is in the Bible, and the Bible doesn't change every day. The tax code does. I don't know a lot of people that have memorized the Bible. So CPAs really don't know the tax code. They just know whatever they specialize on, or maybe they put numbers in boxes. Why do you think the CPAs aren't the ones championing this?
I think it's because CPAs perceive their role to be the person that saves you money today. Most Americans don't understand that you can either pay taxes today or later. I mean, their goal when they do their taxes is to get a tax refund. If the CPA does not get you a tax refund, most people perceive that as being bad tax planning. If you recommend a strategy that causes people to pay more taxes today, even though it's at historically low tax rates, then that sort of is off-putting to the average American. So CPAs understand that. They understand that their job, their perceived job from the American public, is to save taxes today. I mean, that's, even my own brother-in-law, who's my CPA, says, hey, look, we got to save you more taxes today. What can we do to save you more taxes today? So it's all about saving taxes today. So the CPA, what he does at the end of the years, he's like that general or the medic that gets on his horse and travels out across the battlefield and says, this is the casualty, this is what you owe. Our job is to be more forward thinking and say, look, how can we be more proactive in situating assets so that we can pay as little taxes at a period in our life when we can least afford to pay them, and that's in retirement.
Right. Well said. Very good. Well, what kind of response did The Power of 0% get? What kind of response did the book get when you released it?
Well, when I released it, it shot up to #1 in retirement planning on Amazon, and it stayed there for a couple days. And that's not saying a lot. The thing that I've been very happy with is that it's been consistently, even here we are 2 years later, consistently a top 10 book on Amazon. So that tells me that not only are advisors getting it for their clients, but that the general public is looking at it and feeling like it's a timely message that applies to their situation. So it's been a very nice ride.
That's wonderful. So you've got the new book coming out. Okay, Look Before You Lerp. What motivated you to write this? Is this part 2, or kind of what's Look Before You Lerp?
Yeah, so Look Before You Lerp is sort of the sequel, if you will, to The Power of Zero. The Power of Zero basically says, hey, look, tax rates in the future, I don't know if you know this, but tax rates in the future are likely to be dramatically higher than they are today. If that's the case, you got to change everything, your entire paradigm about how you save for retirement. And if tax rates are going to double, the idea is to get you to the 0% tax bracket. Why? Because if tax rates double, 2 times 0 is still 0. Oh, and by the way, there are only a finite number of streams of tax-free income that can help contribute to you being in the 0% tax bracket. One of which is what we call the life insurance retirement plan, which is sort of like a Roth IRA on steroids. It's got all of the tax-free attributes of the Roth IRA without any of the constraints of the Roth IRA. Namely, you can put as much money as you want. There's no income limitations, so on and so forth. So one of the biggest questions that my clients have after having read the book is, tell me more about this LIRP. Tell me more about this life insurance retirement plan. And what I wanted to do in the second book was simply to say, hey, look, not all life insurance retirement plans are created equal. Just like most people, when they were out on the dating scene in their early 20s and early 30s looking for the ideal special someone, they probably had a laundry list of things they were looking for. No one got married on the first date. They dated around. They had things that they were looking for in an ideal spouse. Unfortunately, what I see these days is some people will go out and get an LIRP without even considering all the alternatives. And it's literally a lifelong proposition. When you sign on that dotted line, the LIRP is only going to be valuable to you if you keep it your entire life. So why are people signing up for things that will only be valuable to them if they keep it over the arc of their lifetime? Why are they signing up for these things without doing their due diligence? And so what I wanted to do with Look Before You Lerp was create that laundry list of things that people should look for in the ideal LIRP if they have intentions on getting to the 0% tax bracket.
Perfect. That would be useful.
Yeah. So I sort of set the gold standard.
Because sometimes people hear these strategies and then they'll go out to a brand name or a well-known captive insurance company that also does car insurance and fire insurance, maybe someone they've seen on TV commercials, and they ask for this tool. And yes, those companies have the tool, but they're structured very differently as far as the expenses, aren't they?
Yeah, I mean, there's four things that I talk about in the book that you have to be sort of keenly aware of. The first one is that you've got to have safe and productive growth. I talk about how if you try to grow money in an LIRP and you lose 30% because it's in the stock market, a lot of people don't realize this, but that causes you to pay more insurance expenses. When your money goes down, it causes the amount of insurance you're paying for to actually go up. And if that happens at a period in your life when you're older and the insurance expenses are higher, then it sort of sets this chain of events in motion that can eventually sort of cannibalize your policy. So I think it's important to have safe and productive growth. I think it's important to have a guarantee in place that says that you can never lose money. You can never do worse than zero in your LIRP. So that's one of the things that we look for.
Perfect. Now, you may know this story. I was actually working with somebody in your company way back when I first found you, but the compliance group I was with just was shutting down everything I wanted to do in working with you.
Mm-hmm.
And so I had not been offering the software that you have, which I think is amazing, to my clients and my listeners. And I want to offer that today. I want to start doing that. I switched compliance groups so that I could work with you.
Oh, great. Perfect. Outstanding.
So what can we offer to the listeners? So they're listening to this going, yes, I want to be in a 0% tax bracket. What is it? Tell us a little bit about your deliverable and
Yeah.
what they can get through me.
Yeah, so what we do is what's called a before and after. And people have heard of the before and after with the Bill Phillips body for life back in the day. You got the before where you're sort of fat and pudgy, and then you got the after where you're sort of lean and muscular and all that. You can actually do the same thing with your retirement projections. The before looks a little bit like this. What we do is we take all of your assets and rates of return and inflation, and we do a projection. We say, hey, look, if you never met us and you kept on doing exactly what you're doing, you didn't change a thing, tax rate stayed relatively level for the rest of our lives, sort of defying the math that David Walker talks about. If all that happens, how much money will you be able to spend after tax, and when will you run out of money? And then we show people. And there's some instances where people run out of money at age 80, and they say, well, that's great. And I say, well, if you run out of money at age 80, you can either die or move in with your kids. And most people would rather, and I sort of let them fill in the blank. A lot of people say, I'd rather die, right? But the point is this: the before is a snapshot of your current path. If you don't change anything about what you're doing, assuming certain variables, how long will your money last? And I think for a lot of people, it's useful to know how long their money's going to last. Are they on the right path? And then the second scenario that we run for people is we say, hey, look, what if you never met us and you never changed anything about what you're doing and tax rates double? They go from, say, 25 to 50, like David Walker's predicting. How much sooner will you run out of money? And it isn't unusual for us to see people running out of money 15 to 17 years faster simply because tax rates doubled. And then the final comparison that we run in that before and after comparison is we say, hey, look, if we lay out a roadmap for you to get to the 0% tax bracket, if you do A, B, C, D, and E, and we can get you to the 0% tax bracket, get your Social Security tax free, insulate you from the impact of rising taxes, how much longer will your money last? And if your money lasts an extra 10 years, you spend an extra $1.5 million simply because you accumulated the right amount of dollars in the right types of accounts, then I think at that point it's worth looking into. So that's the before and after. That's what we give to our clients. We want to sort of attach a price tag to inaction. We want to show people what the cost of staying on their current path is. And in many cases, the cost can be in the millions of dollars.
That's incredibly useful because, it seems to me like in financial services, every mistake you make, you pay for 10, 15, 20 years later. So it's hard for people to relate the mistakes they're making to the pain it causes, right?
Right. Yeah, we have to quantify it. We have to quantify it mathematically. And on the same token, if we're going to improve their situation, if we're going to recommend, a solution that goes against their most basic paradigm, a lot of people are sort of paralyzed because they've been weaned on this idea that they need to accumulate dollars in tax deferred accounts. And then we come along and say, hey, look, that's an outdated paradigm. Tax rates are likely to be much higher. If that's the case, we've got to shift course. So a lot of people can be paralyzed because that's a sort of a difficult transition to make. So a lot of times when we show them, mathematically speaking, if they adopt the tax-free paradigm, and we can quantify how many dollars ahead they'll be, it's helpful in sort of assisting them in making that transition.
Yeah, exactly. So what's next for you? I know Look Before You LERP is just out, but what are you excited about in your career and where are you headed to help people next?
Well, we're still sort of getting Look Before You Lerp off the ground. We've got the Kindle that just came out today. We've got the audio CD that's coming out in a few weeks. So really, we're just building our practice. We've got, as you know, we've got a practice. We work with about 90 advisors across the country, helping them build their practices with this type of planning. So really, we're just spreading the word. We're trying to help as many Americans as we can because we feel like, the analogy that we use in the book is that Americans are sitting on the train track. There's a huge freight train bearing down on them. It's bearing down on them in the form of higher taxes. And so our goal is to help get people off the train track. So I think right now we're just trying to expand our scope, the scope of the number of people we can help.
Very good. So the software you mentioned, our listeners can get a copy of this before and after for their own situations, right?
Right, exactly right.
Wonderful. I'll talk a bit more about that as I close the show after we're done here. But any final comments, anything else you want to say to the world?
Just sort of be open to the prospect of a paradigm shift, and that there's a 95% chance that you have the lion's share of your assets in your taxable and tax-deferred bucket. If tax rates in the future are likely to be higher than they are today, then mathematically speaking, you're better off if you start to transition some of that money to tax-free.
Perfect. Very well said. Well, thank you, David. Thanks for being with me today.
It's my pleasure. Thanks for having me.
Folks, I hope you enjoyed the interview with David McKnight. I've had one of his books on my website under the books to recommend for a long time now, probably about a month. It's called The Power of Zero. That's how to be in a 0% tax bracket, which you heard us referencing. His new book I'm also adding, so you can get both books from my website. Just go to my website, jewett.wealth.com, JEWETT wealth.com. On the right-hand side, you click the More button, and then you go to Books That I Recommend, and there'll be direct links to buying both of David's books. I haven't read Look Before You Lerp yet. It's brand new. I'm going to read it, but I loved his first book, so if this is a follow-up to that first book, then I'm sure it's going to be just as amazing. Go to my website, get those books, and enjoy those. Talk to you soon. Bye-bye.
Renovating Retirement with Charlie Jewett.
That's all, folks.